Hello everyone and welcome to another edition of Emkay Macro and Markets. Today I have with me Mr. Hariharan, who's the head of sales at Emkay Institutional Research. Good to have you, sir. So just to look at what's been happening in the markets and across the world, at the start of the year, there's still a lot of uncertainty around the world, even though we can say that it's a little bit less than what it was last year, but we're still not in the clear with regard to a lot of problems or a lot of things that were going on, around the world. So what I'd like to ask you is, as we sort of we have entered 2023, so as we go into the new year, what do you think are the global risks that could sort of filter into India this year?
Hi Harshal. So it's obvious that the sources of uncertainty externally have not changed very much. For us, what has definitely happened over the last 6 to 9 months is that our visibility on the domestic economy has improved a lot. But any vulnerabilities that emanate from external factors, those have not improved in terms of, again, visibility. Basically, to the extent that trade is going to remain an uncertain factor, both in goods as well as in services. One meaningful source of uncertainty is going to be crude oil, because if there is a further flare up in the spring with regard to the Ukraine war, then that may have spillover effects into crude oil pricing. And the last bit of uncertainty is how China fires up its growth engine in the coming year. I mean, they have reopened. We don't know what are going to be the lingering after effects of the COVID spike that they've had and what model of growth they will follow. There is some commentary that they may not go back to the model that was there earlier, but at the same time, it is also known that every country that's bounced back from a COVID spike has seen a material jump in goods demand, which flows through into basic goods demand and ends up becoming somewhat inflationary.
Right. So it's interesting that you bring up the China reopening here, because of course, as you mentioned, it is one of the big factors that will drive the global economy in whichever direction this year. But it's also material for India in terms of foreign flows. Now, last year obviously was an extremely volatile year for foreign flows into India. Now, this year, do you see the China reopening having a material impact on foreign flows? Because essentially, if China does reopen, we sense that a larger share of the pie or a larger share of the flows that go to EM, emerging markets, could now flow to China because those the market is now open. Do you think that could detract from flows that could come into India and therefore obviously have a bearing on Indian markets?
So I want to break this, the answer to this question into two parts. One is the fact that yes, there is a meaningful valuation disparity in that China. If I ignore the recent rally, then it was trading at 7-8 times earnings. Even now it's at 10 to 11 times forward earnings estimates. That compares with 18 to 19 times for India. So yes, there is a dramatic valuation disparity which hasn't existed. Secondly, that because of the visibility that reopening brings into the picture, obviously earnings growth is going to accelerate. That said, we should not look at the flow picture as a zero-sum game, in that the global liquidity position right now has turned meaningfully to the positive for at least the next 3 to 4 months. I'll tell you why. Because treasury deficit spending in US is approximately $80 billion per month, and the TGA account has approximately $350 billion. So deficit spending in US, so even if QT continues, this deficit spending is going to overcome the impact of QT from the Fed. So the liquidity situation in US is going to continue to have a slight easing bias rather than a tightening bias over the next 4 months. In Europe, TLTRO will kick in only after April, and BOJ is committed to easing in the near future. So in this whole scenario, what I see is that the global liquidity situation continues to remain easy for the next 3-4 months, by when I anticipate that we may have even more clarity on how the China reopening is going. So whether there is going to be a slight shift away in terms of asset allocation from DM equities to EM equities? We don't know, but there is a meaningful probability of that happening. So the question that you asked about flows moving away from India into China would happen only if the total EM asset allocation remains static. But I suspect that there is a chance that the whole EM pool might expand a little bit because of greater visibility. We already know that the EM universe has better growth visibility as of now relative to DMs. Of course, there are going to be spillover effects if DMs end up slowing down, if Europe and US drop into recession this year, it will have knock-on effects into EMs, but that is at a later stage. In the initial going, we will continue to post stronger growth numbers in EM.
Fair enough. So then if we're saying that, EMs are going to post stronger growth numbers, of course, India as well, focusing on India, growth will probably be robust, even though it may come down this year a little bit from last year. So focusing specifically just on the Indian economy and Indian markets, I want to ask you, what are the drivers for growth and what are some of the risks for growth, and therefore again for markets in 2023 that you see for India?
So for us, the one thing that we need to remember is that if I look at a longer timeline of Nifty earnings growth, if you look from 2014 to 2020, we had negligible growth. I mean, earnings grew at a compounded rate of about 1 to 2%. And pretty much all of the CAGR over an 8 to 10 year period that you see has come in the last 2 years, in which period margins have expanded, interest expenses have dropped, depreciation has kind of tailed off, and capacity utilization has risen. We also had a bunch of one-offs impacting earnings in the period, the 5-year period pre-COVID, which has gone away. So bank balance sheets are clean now, so we don't have the overhang of one-off write-offs. We don't have the problem of volatility in Tata Motors earnings. Tariff hikes in the telecom sector will provide visibility for profitability to return into that sector. It used to be a loss-making sector. Steel was a loss-making sector. That has now turned profitable. So all of these components of Nifty earnings have changed for the better. Overall leverage situation is comfortable, and credit growth, credit demand, there is a high degree of visibility for that. So in such an environment, we have visibility for consistent 15% CAGR in earnings. So that being the case, the valuation paradigm, which everybody seems to be focused on, may not be the right way to look at things. I mean, it could be that we stay richer for a bit longer because the visibility of earnings growth over a sustained period has happened after a long gap. If anything, we may possibly compare this period to the 2004-05 period where visibility on growth was very high. And where it comes to our domestic economy, the only major source of risk, which is the domestic consumer. There are already anecdotal reports from pretty much all the companies, the consumer oriented companies that have reported earnings so far have alluded to the weak rural consumer in particular. Entry level goods are finding fewer takers, but that is a problem that anyway gets solved when the employment problem is solved. So I mean, with government focus, staying on capex, and to a certain extent the revenue expenditure that the government is going to continue to do will help this get over. I mean, it will probably end up being a cyclical phenomenon rather than a structural issue. So that being the case, I think there is very high earnings visibility. Whether we trade at 18 times multiple or probably end up coming down towards 16.5 to 17 times multiple through a course of prices not moving. So essentially you don't see any meaningful downside to markets.
Got it. So that's it from us today. Thank you for watching and stay tuned for more.
Thank you.